Welcome. In today's lecture, we'll be focusing on option contracts. Options are a type of derivative security that adds complexity to the investment landscape, offering both opportunities and risks for investors. An option is a derivative security that derives its value from the price behavior of an underlying asset. Options give the owner the right, but not the obligation, to buy or sell an asset at a specified price within a given period. There are two primary types of options. One, call options give the holder the right to purchase the underlying security at a specified price within a specified time. Two, put options give the holder the right to sell the underlying security at a specified price within a specified time. Options can be used for various purposes. Speculation, where options offer a cost-efficient way to bet on price movements of underlying assets. Hedging, where options help reduce risk exposure of other investments or portfolios. Transaction costs, as options can reduce transaction costs. And tax exposure, where options can help delay or reduce tax exposure of an underlying asset. Let's go over some key option terminology. Buyer, also known as the holder, has the right to buy, which is a call, or sell, which is a put, the underlying asset and pays the premium. Seller, also called the writer, is obligated to sell in the case of a call or buy in the case of a put, the underlying asset if the holder exercises the option and receives the premium. Premium is the cost of the option, paid by the buyer to the seller. Strike price is the price at which the option holder can exercise the option. Expiration is the date when the buyer's rights under the call or put contract terminate. American options can be exercised any time up to expiration. European options can only be exercised at expiration. Options have specific values associated with them. Intrinsic value is the value of an option if it were exercised today. For calls, it's the stock price minus the strike price. For puts, it's the strike price minus the stock price. Time value is the difference between the option's market value and its intrinsic value. Moneyness describes the relationship between the strike price and the current trading price of the underlying security at the money. The market price equals the strike price in the money. For calls, the stock price is greater than the strike price. For puts, the stock price is less than the strike price. Out of the money. For calls, the stock price is less than the strike price. For puts, the stock price is greater than the strike price. Let's consider an example. Olivia wants to purchase Apple stock, currently priced at $100 per share. She buys a call option, allowing her to buy the stock at $100 per share anytime in the next 3 months, paying a $20 premium. Strike price, $100, expiration 3 months. Profit if stock price is $145 per share minus the $20 premium equals a $25 profit. Loss if stock price is $72. The option finishes out of the money, resulting in a $20 loss, which is the premium paid. Scene transition options positions. There are 4 basic positions an investor can take with an option contract. 1. Long call, buying a call option. 2. Long put, buying a put option. 3. Short call, selling a call option. 4. Short put, selling a put option. For a long call option, the gain or loss equals the difference between the security price, S, and the strike price, X, less the premium, P. If the security price does not increase, the loss equals the premium paid. For a short call option, the gain or loss is the opposite of a long call. The maximum gain equals the premium received. If the security price increases, the loss can be unlimited. If the price of the underlying asset goes up, the buyer can exercise the option and buy the asset at the strike price. The seller, on the other hand, is forced to sell at a price below market value. Now, if the price goes down, the buyer will not exercise the option and loses the premium. In this case, the seller keeps the premium and makes a profit. Using leverage, an investor can magnify returns. For example, if the stock price increases from $50 to $75, the buyer of the call option could realize a 400% return compared to a 50% return if they had purchased the stock directly. A put option allows the holder to sell the underlying security at a specified price. The buyer benefits if the asset price goes down, while the seller does not want the price to decrease. Scene transition, basic payoffs, long put options. For a long put, the maximum loss equals the premium paid, while the maximum gain occurs if the security value drops to zero. Scene basic payoffs, short put options. For a short put, the maximum gain equals the premium received. The potential loss is limited as the security price cannot drop below zero. Scene transition, how puts work. If the price of the underlying asset goes down, the put owner can sell the asset at the strike price. The seller pays more than the market price. If the price goes up, the put owner will not exercise the option and loses the premium. The seller keeps the premium and makes a profit. The intrinsic value of a call option is the stock price minus the strike price, while for a put option, it's the strike price minus the stock price. The time value is the difference between the premium and the intrinsic value. Example 1. A call option with a $2 premium and a $50 strike price has an intrinsic value of $1.50 when the stock price is $51.50, making the time value 50 cents. Example 2. A put option with a $3 premium and a $30 strike price has an intrinsic value of 0 when the stock price is $32, making the time value $3. There are 4 types of option orders. 1. Buy to open, buying a call or put option. 2. Sell to open, selling a call or put option. 3. Buy to close, closing a previously opened short position. 4. Sell to close, closing a previously opened long position. Options have specific expiration dates, often following one of 3 cycles: January, February, or March sequential cycles. The last day of trading is typically the 3rd Friday of the expiration month. Options can be traded on various underlying assets, including common stocks, stock indexes, ETFs, foreign currencies, debt instruments, and commodities. Common option strategies include 1. Protective put, combining a long position in a security with a long put option. 2. Covered call, selling a call option while owning the underlying stock. 3. Protective call, buying a call option to protect a short position. 4. Collar, combining a long put with a short call to limit gains and losses. 5. Straddles, combining a long put and a long call with the same strike price and expiration. Some securities come with embedded options, such as callable bonds, convertible bonds, and warrants. These embedded options affect the overall value of the security. The 2 most common models for option valuation are: 1. Black-Scholes option pricing model uses continuous time intervals and considers factors like stock price, strike price, time to expiration, volatility, and risk-free rate. 2. Binomial option pricing model estimates option prices by tracing discrete movements in the underlying security until expiration. By understanding option contracts and their various applications, you can enhance your investment strategies and manage risks more effectively. Thank you for joining us in this lecture on derivative securities at University Name. Let's continue our journey towards becoming proficient investors.